Let's take a look at that dynamic that's affecting the equities market space. I touched on it just a while ago, looking at the fact that we've got investors starting to divert their attention away from the equities game and into the fixed income space.
Thank you, Alishia. Well, what we're seeing in the market is investors take profit. We've seen the market rally close to 8% year to date, and on the last 12-month basis, up about 18%. At this moment, it's only appropriate that investors try and take profit and channel funds into the money market, which are yielding higher rates as a result of a raise in the MPR by the CBN last week. So we expect this trend to prevail for a while, but in the long run, we expect it to balance out and we will see the market start trending upwards.
So which side of the fence are you sitting on right now? Just taking a look at your weightings and portfolios, are you a part of that shift and that trend that we're seeing, or are you holding steady at this stage?
Well, like I said, in the long run, we're very bullish on the equities market, especially the banks. We know what AMCON is doing. We expect the banks to drive the market in 2011. So we're skewed towards equities 70–80%. Then maybe the fixed income space 10% and money market 20%.
Well, let's take a look at some developments then that could well affect some of the activity we're seeing in the banking sector, specifically AMCON saying this week that it was delaying by a month the issue of that 1.5 trillion naira in tradable bonds, but said that it's still on track to absorb all bad bank loans on time. Any negative market reaction to that announcement, or is the market still sitting reassured at this stage?
Well, I think it's still too early to make that call. We anticipate that the banking reforms will be completed in Q3 11. So by AMCON extending the date, I don't think it's something that's a cause for concern. We usually struggle with regulatory issues, getting approvals in this part of the world. So it's something that analysts would have probably factored in. And so I don't see the negative turn in the market related to that.
So let's take a look at a few players within this space. I mean, tier 2 corporates are to a large extent being expected to drive loan growth, so triggering some renewed interest on players like an Access Bank in the medium term. Do you share that sentiment? Because the other view out there is that the bigger the bank, the better. So which side of the fence are you sitting on in that regard?
What we feel at Chapel Hill is that the tier 1 banks actually have more latitude to lend. Most of the tier 1 banks have loan to deposit ratio probably around 50%, so they have more room to stretch their balance sheets. For the tier 2 banks like that of Access, though they have very high capital adequacy levels, but they really are almost fully stretched, and unless they can grow their deposit base significantly in 2011, we don't expect them to really grow their loan books that much this year. So I would pitch my tents with the tier 1 banks to probably outperform the tier 2 banks.
Let's take a look at a player like Access Bank, though. I mean, we've seen a recovery in asset quality there. On a year-on-year basis, the NPL ratio has improved to 11% from 20% in the third quarter. And with that, it's expected to participate in a general increase in lending to sectors like, the oil space, the telecom sector as well. What's your overall view on a player like Access Bank?
Well, for Access Bank still remains one of the fastest growing tier 2 banks. For the NPL recoveries we saw last year, it was a one-off thing. We saw that happen in the first quarter of 2010, and the NPLs remained pretty flat for the rest of 2010. In 2011, we don't really see that impacting their lending going forward, and I expect 2011 probably will be better than 2010, but we don't expect to see much growth. Maybe we'll see a 10 to 15% growth in loan book.
Of course, so one of the risk factors to consider is that we've got Access Bank currently in M&A talks to acquire one of the affected banks, and so expected is some execution when it comes to risk of combining entities at this stage. Just how risky a position does this put the bank in your books?
Well, like I said earlier on, Access Bank has a very healthy capital cushion. They have capital adequacy ratios of close to 30%. So I think they have enough capacity to take on any other player in an M&A deal. In terms of the risk assets of the acquired bank, well, they will probably acquire those assets at mark-to-market value. So I don't see that affecting Access Bank's cushion in terms of capital adequacy.
We've seen this week the bank make an announcement that it plans to divest fully from its two non-banking subsidiaries, with a focus on its core retail operations instead. What is the market made of that restructuring?
Well, for Access Bank, they embarked on an aggressive expansion strategy in 2007, where they went into investment banking, they went into insurance, they went into registrarship. But over the last 2-3 years, we've not seen those businesses contribute much to both top line and bottom lines. And so as such, we wouldn't expect them to be bullish on those segments. And that's why we're seeing the bank divest from those areas. From the market's view, we saw Access Bank trade really strong in 2011. The bank has advanced close to 12% year to date, although we've seen Access Bank retrace its steps. I don't think the market is factoring in their announcement, because we feel that that's probably the best course for the bank for this year.
Kingsley, looking at the day ahead, anything specific that you've got your eye on?
Well, we still expect to see investors take profit, especially amongst banks. But we'll probably see that cycle slow down probably at tomorrow's session on Friday, and when we'll start seeing the market trade up.